Hello everyone, welcome to Sharevidya's YouTube channel. We are here to bring forth a series of videos about stock markets and finance so that you learn the basics of it and take profitable trades. The objective of today's video is to learn the concepts of stock market and how does it work, some important jargons of stock markets, and 5 tips to get you started which are important to sustain in stock markets. Now we have all heard about the stories of stock markets from people around us. There are some set of people who tell us the positive side of it, that people are earning a huge amount of money. But then on the other side, there is some set of people who have actually lost money in it. So we are faced by this dilemma that should we actually invest in it? Well, let me tell you one thing. Just like any other thing in this world, stock market is a science too. You need to know the rules of the game so that you play it well. And we are here to teach you the rules so that you earn better. Let's start with the concept of what actually is a stock market and what actually are stocks. So the first stock exchange in the world was established in a roofless courtyard in Amsterdam. It is called as Antwerp and it still exists. The first company to list on the stock exchange was Dutch East India Company. Now there are various reasons for the emergence of the system and they are actually simple and dates back to early modern world. Let me tell you a story related to it. So there was a merchant who wanted to pioneer his ideas into a big budget business. But the sad thing was that he lacked the huge capital to start his business. He even tried to borrow from his friends and family, but still it was a pretty huge amount to satisfy. Surprisingly, one day he met a group of investors who were ready to give him their idle funds. So this person was really amazed and happy that he finally found the lenders. But here is the catch. The investors said one thing which was very uncommon in those days. They said, we don't want interest on our funds, but we want a percentage of your earnings. Now the merchant became a bit hesitant. He thought, what if his company would be taken over by these lenders? But because he had no other option to raise money from, he trusted them and gave them a certain percentage, which are also called as shares, of his company to these investors. So when this news broke to other parts of the city, lending money to get a percentage of share in the business became the trend. When people felt they no longer want to stay invested in that company, then they sold the shares to some other investors. So day by day the market base increased. There was a need for having a place where all the buyers and sellers could meet and take trades. That's how the concept of stock exchange came into existence. As more and more trades started taking place, it became impossible to maintain a track of it. Therefore, to make it more convenient and simple, the first company to issue paper shares were the Dutch East India Company. This made trading shares very easy because you just had to give a paper and take the money. This is how there were so many evolutions happening in stock markets. Stock markets are now operated digitally, where buyers and sellers trade shares of the companies they like. Now talking about the Indian markets, Bombay Stock Exchange was the first exchange formed in 1875, where investors used to gather at Mumbai's Dalal Street to trade shares. If you see the word Dalal Street comes from the Hindi word Dalali, which means bidding of shares. So back then, the system which was followed was the open outcry system, where traders or their jobbers had to shout to make their quotations and bid for shares. So the highest bidder for the stock gets the shares from the seller. When India underwent the LPG revolution in 1991, it paved way for digitalization in almost every field. So even stock exchanges were not behind. That's when National Stock Exchange came into existence in 1992. It is the first dematerialized stock exchange in India which is operated digitally through a trading terminal. Following this suit, even Bombay Stock Exchange got converted into dematerialized stock exchange. So now traders buy and sell shares virtually which get deposited in their demat account. Now, these two big stock exchanges in India have their own indexes. Now, what are indexes? Indexes are basically a platform which measures the performance of top companies listed on these exchanges. For example, BSE has an index called Sensex, meaning sensitivity index. So it has 30 top companies representing various sectors. As the price of these companies change, the Sensex change. Also, these companies keep on changing daily as their market capitalization changes every day. Same applies to NSE's Nifty 50, which consists of 50 companies representing different sectors. Now, talking about how do you exactly earn from stock markets? There are three options. First is the capital gains, which is when you buy a share and it appreciates, and when you sell it off, you get a capital gain. Like for example, if you invested in Reliance Industries today at 2000 rupees and tomorrow, no, not tomorrow, after 10 days, if suppose the share price reaches 2100, then there is a capital gain of 100 rupees. Similarly, there can be capital loss also, but we are going to tell you how to avoid it. So stay tuned. The next is the dividend income. So when a company whose stocks you hold have surplus funds in its pockets, they issue dividends in order to make their investors happy. Dividends are a percentage of the face value of shares. Third comes the bonus shares. Just like dividends, when companies have high surpluses in their pockets, they issue bonus shares to their investors. This is usually in proportion with the shares you hold. For example, if a company issues bonuses in the ratio of 1:3, it means that for every 3 shares you hold, you get 1 bonus share. So isn't it such an interesting thing to earn from stock markets virtually by doing actually nothing? For that, you also need to know the important jargons related to stock markets. The first one is the list price. List price is also called as the market price per share. So if you see, we have taken the example of Reliance Industries. The list price of Reliance Industries is 2120.70 rupees. The list price keeps on changing every second as trading activity takes place every second. Now let's come to opening price. So every day stock markets open at 9:15. So the first price traded at 9:15 is called the opening price. This opening price is matched with demand and supply so that it can also be a gap up or a gap down, which we will be explaining later. The third comes the closing price. Every day at 3:30 markets close down. So the last price the share traded at 3:30 are called the closing price. Similarly, high price is the highest price touched by the share in that day, and low price is the lowest price touched by that share in that day. If you see, previous close is actually the closing price of previous day. This previous close is very important to determine the percentage change today. So for example, gap down is the percentage decrease in shares from previous closing price, and gap up is the percentage increase in share price from previous closing price. So usually gap up is highlighted through green and gap down is highlighted through red. Now coming to lower and upper price band. So every stock has a limit of price. The upper band is the price beyond which the share price cannot exceed for today, and the lower price band is the price beyond which the share price cannot fall. This is done to ensure that there are minimum losses to investors due to daily price actions. Then comes the 52-week low and high. 52-week low and high are the prices which are highest and lowest in an entire year achieved by the share. Now coming to the volume. If you look at the chart over here, the bars that you see in red and green are called as the volumes. So for example, if 1,000 people bought Reliance today, then even 1,000 people actually sold Reliance to these people. So today's volume is 1,000. To quote it in a definition, volume is number of shares traded per day. Now coming to target price. Brokerages give target price by expectations that the share price will reach their target price in a certain period of time. Stop loss is the concept that you minimize your losses so that you have to exit when the price touches your stop loss price. Then comes the circuits. Every stock has a circuit. Circuit is the percentage increase or decrease which a stock can have on a specified day. These circuits range from 5%, 10% and 20%. So for example, if you have bought a share of 100 rupees today, then tomorrow it reaches 110, then your trading activity halts for that day because the share price is locked in at 5% circuit. Similarly, if it goes down to 90 rupees, then the trading activity halts because the share price is locked in at 5% below circuit. Now comes the important objective of this video. 5 tips to get you started. The first is that you choose the right broker and open your demat and trading accounts with them. The reason to have the right broker is because of the services that it gives. Because you are new in this field, it is important that you have a true guide who can take you through this journey and make your life and stock market journey profitable. The second is start small in practice. As a beginner, it is advisable that you take small trades so that even if you incur losses, you just learn from it and it doesn't cost you much. The third thing is keep learning and researching. Because of the dynamic nature of stock markets, it is important that we keep learning and updating ourselves. That's why we bring to you this series of videos which will keep you updated about the latest happenings and concepts of stock markets. The fourth thing is to maximize gains and minimize losses. This is the thumb rule of stock markets. It is important that in the quest to maximize gains, we also minimize our losses. For example, if we have a 2,000 rupees profit today, but we have this greed that, oh, I want more, so I'll wait. But tomorrow, the share price falls to 1,000 rupees down. The share price fall and you have a loss of 2,000 rupees. So it is better to know when to exit. So you need to have your stop loss price wherein you cut off from that trade to ensure that you have minimized losses. The fifth and the most important thing is keep earning and excelling. The main objective of stock markets to make profits, right? So you keep learning and earning so that you excel in this journey of stock markets. Well, thank you for watching this video. Stay tuned to Sharevidya for more such videos. Thank you and have a nice day.